again. Thank you for joining me this evening. I'm James, market strategist at Tiger Brokers Singapore. So I'll be discussing Singapore tourism and hospitality stocks today. Can Singapore tourism stock shine in 2024? And this is the disclaimer provided to you for education and sharing purpose only. And today I will providing you with some insights into Singapore tourism industry. There is a new visa agreement starting February 9, which allows citizens of Singapore and China to enter each other's country without a visa for a stay of up to 30 days. So naturally, this will bring in more Chinese tourists to Singapore and should help push up the stock prices of some tourism and hospitality stocks. Today, I will mainly discuss SIA, Far East, Hospitality Trust, and Genting Singapore, which I believe will be the main beneficiaries of this visa exemption agreement. Let's talk about Singapore tourism industry first. The tourism sector currently contributes 4% to Singapore's GDP. In contrast, Thailand tourism sector contributes 22% to its GDP. Malaysia's contribution is 13% and Japan's is 7%. Therefore, Singapore's 4% figure is relatively low compared to other Asian countries. A positive aspect is that when COVID-19 hit, many local companies in Singapore were not as severely affected compared to tourism companies in other countries. Singapore is also famous for its business-friendly reputation and has consistently held the position as the world's best business environment for 15 consecutive years, according to the Economist Intelligence Unit. Therefore, Singapore has become the preferred destination for business travel, especially for high-end corporate travel. This implies that when business travelers visit Singapore, they are more likely to stay at five-star hotels, dine in fine dining restaurants, and probably you will see more global corporate conference held in Singapore going forward. Singapore is a great location for events and exhibition. However, due to the popularity of Zoom meetings and cost-cutting measures, corporate events are not as frequently as they were before the COVID-19 pandemic. And we have been seeing there has been a decrease in the number of some high-profile summits happening in Singapore as well. In addition to corporate conference, sporting events and concert also play a crucial role in revitalizing Singapore's tourism sector. For example, the Formula One race held annually in September is a major sporting event in Singapore. During the F1 week, I am sure you noticed that there were a lot of tourists in Singapore. It was tough to get a taxi, and hotel rooms were hard to secure as well back then. There were more than 28 MICE events organized around the F1 events as well, around the F1 period as well. So even if the F1 event has a low turnout, is attracting more events organized during that period. The MICE industry is also a strong contributor to Singapore's economy, contributing nearly 1% to GDP. To further stimulate tourism, is also essential to host more concerts featuring renowned artists such as Zhou Jielun, Taylor Swift, Blackpink, and Coldplay. In 2023, Taylor Swift's concert is estimated to have boosted the US economy by $4.6 billion, showcasing the significant economic impact of such events. In comparison, it's estimated that Taylor Swift concerts may boost Singapore economy by 500 million. Singapore Tourism Board has also confirmed that a grant was provided to help bring in her concert tour here. And Thai Prime Minister also say that the Singapore government offered 2 to 3 million USD per show in exchange for her exclusivity in Southeast Asia. Singapore Tourism Board did not confirm the news, but I guess it's worth the money. According to the Singapore Tourism Board, international visitor arrivals to Singapore has reached 13.6 million in 2023, which is 71% of 2019 pre-COVID level. In 2024, international visitor arrivals are expected to reach around 15 to 16 million. Personally, I think the number is a bit conservative. I reckon Chinese tourists may provide some upside surprise. And not to forget that it was 19 million in 2019, so we may not have yet seen the full impact of the tourism recovery on the tourism-related stocks. It's also important to know that the CAGR for the international visitor arrival was 6% from 2009 to 2019. Therefore, if the arrivals numbers return to the 2019 level next year, there is the potential to resume the 6% CAGR trajectory. So one immediate question is, why haven't Singapore's international visitor arrivals returned to the pre-COVID level yet? One reason is that tourists, especially those from China, are not returning to Singapore in significant numbers. Here are the arrival numbers in 2023 compared to the 2019 level. The top 5 countries by arrival are Indonesia, China, Malaysia, Australia, and India. Chinese tourists generally account for the majority of the international visitor arrivals in the past, followed by Indonesia and India. However, the top spot last year was Indonesia. Currently, Indonesian and Indian tourist numbers are still 25% to 26% lower than the 2019 level, while Chinese tourist number were 62% lower. Since China reopened in December 2022, why haven't Chinese tourists returned to Singapore? There are likely a couple of reasons for that, such as stronger Sing dollar compared to neighboring countries, and an uneven economic recovery in China. In addition, Singapore is not the top foreign tourism destination for Chinese tourists. They may prefer to visit Thailand and Japan before coming to Singapore. If we look at the tourism receipts from China during the first 3 quarters of 2023, we can observe that they are still 27% lower than the same period in 2019. Historically, Chinese tourists were the biggest spenders in Singapore. It's important to know that while the number of Chinese tourists has decreased by 62% compared to 2019, their spending is only 27% lower than in 2019. In summary, to achieve a full recovery in Singapore tourism, we really need a lot of Chinese tourists to come back and spend like they did in 2019. Let's also take a brief look at the hotel industry. Singapore's hotel industry recorded an average occupancy rate of 81% last year compared to 87% in 2019. The average room rate was $282 in 2023 as opposed to $220 in 2019, indicating an increase of 28% in 2023 in room rate compared to 2019. Meanwhile, RevPAR increased by 17% from $191 back in 2019 to $225 in 2023. This suggests to you that even though the occupancy rate is lower than in 2019, hotel owners are still making a lot more money by charging higher room rates. And I think Singapore hotel RevPAR may stay higher for longer, even if average room rate start to decline due to intense competition. There may still be an uptick in terms of the occupancy rate as a result of the Singapore-China visa-free travel agreement itself. And hence, I believe that the RevPAR may remain elevated. Next, let me briefly share about service apartments. Singapore continues to attract more foreign workers. I believe the number of employment pass EP holders has a positive correlation to their service apartment RevPAR. Therefore, as long as the number of employment pass holders increases, it should have a positive impact on service apartment providers such as Escort REITs and Far East Hospitality Trust. In June 2023, the number of EP holders returned to the pre-pandemic level. The rental index of private residential properties dropped slightly to 161, but is still much higher than what we see in the pre-pandemic high. Generally, if condo rental prices increase, service apartments, which accommodate professionals require long-term stays, will also see an increase in room rates itself. All in all, the industry outlook looks okay for tourism stocks. And now, let's talk about individual stocks. One of the direct beneficiaries from the tourism recovery is Singapore Airlines. It's my favorite tourism stock in Singapore. Because the first thing, the flight ticket itself is the first thing you spend when you enter Singapore. The Singapore Airlines Group owns Singapore Airlines, the Budget Airline Scoot, and a 77% stake in SIA Engineering. Singapore Airlines is the flag carrier airline of Singapore and possesses a strong branding. If budget is not a concern, I believe most of us would prefer to fly with SIA. The main reason for it is a nice share price recovery since COVID is operating leverage. So what is operating leverage, you may ask? Operating leverage is how much of each incremental dollar of revenue a company can turn into profit. To put it simply, during the COVID-19 pandemic, some companies are able to cut costs such as overhead and headcounts, and they keep those cost cuts when the economy recovers. Therefore, they will be able to generate more profits itself. In SIA's example, in terms of revenue, it was 16 billion in 2019, and in 2023, it was 17 billion. But we see a big difference in terms of net profits itself. The net profit was 682 million in 2019, but it was 2.1 billion in 2023, about 3 times higher than 2019 itself. The reason they are able to achieve this is even though the revenue is only 9% higher than 2019, but the total expenditure in 2023 is about the same as in 2019 itself. If we were to look closer, the first 3 quarters of the financial year 2023 and 2024, the revenue was 14 billion and the net profit was already 2.1 billion. So the financial year of 2023-2024 may be the best year for SIA. However, we could also see that SIA has dropped 11% since the earnings announcement lately. I believe the drop in share price is because the earnings missed analysts' expectation and hence the investors reckon they have already seen the peak of earnings growth. And the latest quarterly report also shows some weaknesses as well. SIA operating profit fell by 19% in the latest quarter, which is the main reason for the 11% drop in share price since the earnings announcement. Operating profit was mainly dragged down by total expenditure. The total expenditure, which include fuel costs and non-fuel costs, increased by 9% year over year. One of the key risks for SIA is always rising oil price. Fuel costs in the past has been contributing 26% to 38% of the total expenditure, depending on which period you are looking at. In the latest quarter, fuel cost itself accounts for 32% of the total expenditure. A lot of investors like to see how much fuel cost SIA has earned from hedging. But I try not to read too much into that because SIA does not have the best history of hedging fuel costs. The hedging gain was only 86 million in the latest quarter. It was 56% lower than the same period compared to the same period last year. So I try not to read too much into fuel cost movement because it was too volatile. Higher fuel costs is always an overhanging risk if you intend to invest in SIA. The non-fuel expenditure also increased by nearly 10%. Overall, the total expenditure itself increased by 9.3% year over year. Revenue per available seat kilometer and passenger load factor is currently above the pre-COVID level. RASK itself is 9.9 cents now compared to 7.5 cents pre-COVID. This means that SIA makes about $99 per seat for every 1,000 kilometers it flies. Passenger load factor is 88.2% now compared to 82.4% pre-COVID. The RASK and PLF, passenger load factor, will normalize, will go down for sure. SIA has also guided the passenger yield normalization to continue as competitors gradually restore their flight capacities. But management also indicated that the demand for air travel in the first half of the year remains solid as the forward bookings remain strong enough due to the upcoming March school holiday period and the Easter holiday season as well. The passenger yield for SIA and Scoot declined by 5% and 15% year on year in the latest quarter, which were worse than the street expectation. Recently, I also saw the flight ticket price to Osaka in March was 20% lower than 2 months ago. But I guess basically the passenger yield may continue to suffer. But I think in 2024, this metric could still remain elevated itself since Singapore tourism is still recovering due to Chinese tourists returning to Singapore. One of the reasons I like SIA is market share. Singapore Airline Group's owns the largest market share in terms of Singapore Changi passenger, with SIA and Scoot have a combined market share of 43%. Cargo, on the other hand, is not doing so well. Air cargo demand is not as strong as compared to 2022, and potentially there is weakening global macro condition as well. Even though cargo yield rebounded slightly to 40.3 cents in the latest quarter, it may continue to normalize to 30 cents pre-COVID level. And cargo load factor was 55.5% in the latest quarter, which was lower than the pre-COVID 59.3% level. However, the cargo revenue generally accounts for 13% to 14% of the total revenue. In the latest quarter, the cargo revenue contribution was 11%, whereas it was 14% in the third quarter of 2019 itself. So the revenue contribution in percentage terms is not that significant as compared to 2019. The cargo revenue was 559 million in the latest quarter compared to 635 million in the same quarter of 2019. This represents about 88% of the 2019 level. The decline in cargo revenue is concerning and is probably one of the reasons that may impact SIA future growth prospects. Passenger revenue generally accounts for near to 80% of the total revenue. It was 82% in the latest quarter and about 78.8% in the third quarter 2019 itself. Passenger revenue has been generally doing quite well in terms of the absolute number. It was 4.1 billion in the latest quarter as compared to only 3.4 billion in the same quarter in 2019 itself. The valuations for SIA looks expensive. In terms of forward PB ratio, it was trading at 1.2 times lately, which is more than one standard deviation above the 20 years average. And I also reckon that SIA stock, but I still reckon that SIA stock is fairly priced because you should also look at the earnings growth itself, the earnings prospect. All in all, I think it's hard for a lot of investors to like SIA now. Lower passenger yield outlook, lower cargo yield going forward, operating costs may start to go up. But I still prefer SIA among all the tourism stocks. It has strong brand name. It is the market leader. The investment thesis for SIA is quite simple for me. It depends on whether investors like you believe that Chinese tourists will return to Singapore or not, because SIA should benefit. I think we should see some outside surprise from there, as we are seeing some early signs of Chinese tourists traveling to Singapore. Some news media are reporting that there is an uptick in Chinese tourists bookings to Singapore, Thailand, and Malaysia combined jump more than 30% during the Lunar New Year period, according to Trip.com. And according to Cirium, which is an aviation analytics company, flights from China to Malaysia, Singapore, and Thailand are expected to increase by 87% from March to June compared to the same period last year. And hence, I am mid-term constructive on SIA, but I have to say that I'm short-term neutral on SIA now because we do not know how good the Chinese number the Chinese tourist number yet, as the mutual visa agreement only started in February. And with more competitors restoring their passenger flight capacity, Singapore Airlines may need to lower the ticket prices. But I reckon the recent 11% drop in share price probably priced in the bad earnings results. So I think that SIA may hover around $6.5, around the share price at the moment, and waiting for more news in order to push the stock price higher. SIA may have found the support at its 78.6% Fibonacci expansion level at $6.44. The latest price was $6.5 and may challenge the resistance level at $7 or $7.7 or $8.06 itself. If SIA's share price continue to fall, support levels are 6.44, 6.01, 5.71, respectively. Okay, the next company I'd like to discuss is Far East Hospitality Trust, which is relatively straightforward to comprehend. Okay, Far East Hospitality Trust owns a portfolio of 12 assets, including 9 hotels and 3 service residences, all located in Singapore. The REITs stand out as the only hospitality trust with 100% of its assets based in Singapore. And this is the main reason I like about the hospitality trust itself, because this gives me a clear understanding of the outlook compared to other REITs that owns properties overseas. I would say that it would be quite difficult for all of us to understand the demand and supply dynamics of overseas properties. So normally I prefer pure Singapore-based REITs. But bear in mind that management also say that the company is looking for acquisitions opportunities in Japan in 2024, likely in the second half this year. These are all the hotels and service residences owned by Far East Hospitality Trust, and they are all mid-tier and upscale properties. The portfolio includes properties such as Oasis Hotel Novena, Rendezvous Hotel, and Ardina Service Apartment, just to name a few. Let's look at the breakdown of the gross revenue this year. Hotels accounts for 74.5% of the gross revenue. Service residences contribute 10%, and commercial activities contributes for 15.1%. One notable change is that hotels now accounts for more in total gross revenue, increasing from 70% to 74.5% in 2023 due to tourism recovery. In 2023, gross revenue increased by 27%, mainly due to a 36% year-on-year growth in hotel revenue. Service residences improved by 7.9% year-on-year, and commercial premises increased by 9.2%, not bad. Net property income and income available for distribution increased by 27% year-on-year. Let's talk about the commercial premises first. It now has a total of 177 units of retail and office commercial spaces. About 67% of the tenants by revenue came from food and beverage. Occupancy for retail and office are about 80% and 100% respectively. It has recovered nicely to 16.2 million, approximately 90% of the pre-pandemic level, and accounts for 15% of the total revenue. However, I foresee that the revenue growth moving forward will come from the hotel and service apartments, but not the commercial premises itself. According to the company's calculation, the dividend yield was 6.2% based on 2023 year-end closing price of 67 cents. This 4.09 cents dividend payout in 2023 was 25% higher than 2022 itself. So I would say that Far East Hospitality Trust is doing not bad, considering some other REITs distribution income, the DPU, are declining. Let's now focus on the main revenue contributor, hotels, first. If you recall from my slides earlier, we could all see that Singapore hotel industry has been recovering nicely this year. So we could generally expect a nice recovery for hotel segment itself. The average occupancy rate has seen a 6% growth in 2023. The 80% occupancy rate also aligns with the industry average. The year-on-year growth for average daily rate was $170. The year-on-year growth was 36%, and it was $170 in 2023. The RevPAR itself has also experienced a 47% growth year-on-year at $136. It's also important to know that the RevPAR for the entire year of 2019 was $142 around here. So if we compare $136 that we have seen in 2023 with $142 in 2019, the RevPAR is now about 4% lower than the 2019 level. Now let's look at the service residences. The 2023 occupancy rate increased by 0.3%, whereas the average daily rate improved by 16%, and hence the RevPAR still increased by 17% in 2023. In any case, service residences are performing well. The 2023 second half RevPAR was $234 in the second half, which was 23% higher than $189 during the same period in 2019 itself. In 2023, the fixed rent component in master leases represented in rate bar saw a significant improvement from 6% 6 percentage point last year. 6% growth last year. So the variable rents was 25%. So basically, it actually improved from 6% to 25%. And in 2019, the fixed rent and variable component was quite similar at 59% and 24%. So it was quite similar to the number that we have seen in 2023 itself. I believe that going forward, we should see more revenue growth in variable rent because some of the hotels were under the government quarantine contracts in early last year and was on fixed rent. And there were some AEI last year as well, so that the hotel is not operating in full room capacity. And hence, all room inventories should have been released into the market by now. It is still one of the lowest gear S-REITs with a 31.3% aggregate leverage, and 42% of the debt is fixed rate. In the higher for longer rate scenario, if the FOMC continue to keep the rates higher, Far East Hospitality Trust should be one of the REITs least impacted. Currently, management is also exploring expansion overseas. They are looking to diversify into developed countries, specifically looking into Japan. The aim is to achieve a balanced mix of 80-20 between properties in Singapore and overseas over the longer term. All in all, I believe that it's a good recovery play with an easy to understand business model. There might be some capital appreciation in the future if they acquire valuable overseas properties, but some investors have not been reacting well to REITs that own overseas properties. Just keep in mind. So I also personally prefer Far East to still focus on Singapore properties. You could also see that luxury hotel RevPAR in 2023 is now significantly higher than what we saw in 2019 itself. However, upscale and mid-tier hotel RevPAR, to which Far East Hospitality Trust belongs, lag behind in terms of recovery. Nevertheless, I believe that with the return of budget-conscious Chinese tourists, they may find them attractive, appealing. All in all, the investment thesis for Far East Hospitality Trust is potential overseas expansion plan, tourism recovery. Let's look at the technical analysis quickly. Oftentimes, the company share price find good support at 50% Fibonacci retracement level at 0.565, which is a 6% drop from the current price of 0.605. If you are patient enough, you may look forward to investing at 0.565 based on technical analysis, but personally, my preferred strategy is to invest partly at the current price to at least capture some market return and to buy more when the share price drop or goes up by another 10% itself. Next, let's look at Genting Singapore. Genting Singapore owns Resort World Sentosa in Singapore, one of the largest resorts in Southeast Asia. Resort World Sentosa features hotels, a casino, restaurants, and convention centers. Its attractions include USS Sea Aquarium, Adventure Cove Water Park, and Dolphin Island. In 2019, the revenue and operating income were 2.4 billion and 786 million respectively. In 2023, the revenue and operating income were 2.41 billion and 636 million. Revenue is now 97% of the 2019 level, whereas the operating income is 80% of the pre-COVID level. If we were to look at the profit margin, the gross profit margin and operating margin were 41% and 31% in 2019 respectively, but they have both dropped by 5 percentage points in 2023. The operating profit margin and operating income were disappointing, and this was the main reason the share price fell 12% since the earnings announcement. The main reason for the disappointing operating income was the 318% increase in the provision for doubtful debt from 30 million in 2022 to 124 million in 2023. I know that a lot of investors will take this as a big negative, but I think the correct way to see this is that there is certain risks that the management took to bump up the gaming revenue. So we saw the gaming revenue increase by 34% year on year in 2023 compared to 2022, and it was 1.65 billion in 2023, which is even higher than 2019 number at 1.62 billion itself. As a result, the provision for doubtful debt increased by 318% year on year, which is also higher than 2019 provision for doubtful debt, 100 million itself. But the management also say that they do not expect the impairment for this trade receivable to be as large going forward. So Genting Singapore investors need to ask themselves if they can see past this temporary spike in doubtful debt or not. To me, I think that this is not a great concern because firstly, it only accounts for 7.5% of the gaming revenue. Secondly, Genting Singapore has a history of declaring lesser provision for doubtful debt after a spike. For example, 2016 doubtful debt was 235 million, followed by 50-something million in the next 2 years. In 2019, Genting Singapore declared a high doubtful debt of 100 million, followed by negative doubtful debt in the next 2 years. So maybe the management will do the same thing for the next 2 years as well. Let's break down the revenue for Genting Singapore. All of the revenue is generated in Singapore, which includes both gaming and non-gaming revenue. Gaming revenue consists of casino revenue, while non-gaming revenue includes hotel room revenue, attraction revenue, and food or beverage. In 2023, the total revenue growth was 40% year on year, and gaming revenue increased by 34%, which was 91% of the 2019 pre-COVID level. But bear in mind that for Singaporeans or PRs to enter the casino premises, they need to pay a levy of 150 Sing dollars. Although Genting Singapore does not publish the casino visitors by country, it can be assumed that Singaporeans are not the main contributors to the gaming revenue. Additionally, there is a China crackdown on overseas gambling involving Chinese citizens in recent years. So the crackdown on Chinese high rollers by China in recent years has impacted VIP gaming revenue, and hence Chinese tourists may not contribute significantly to gaming revenue in recent years compared to the pre-COVID times. But again, kudos to Genting Singapore management for successfully attracting gamblers from other countries in recent years to offset the lost gaming revenue. Considering that Chinese tourist number in 2023 are still 60-something% lower than in 2019, gaming revenue could potentially surprise all of us in the coming quarters if Chinese tourists come back to Singapore and gamble. Non-gaming revenue, on the other hand, increased by 58%. Gaming revenue now accounts for 68% of the total revenue, and non-gaming revenue accounts for 31%. Genting Singapore again does not provide a breakdown of the operating income. Comparatively, if we were to look at Las Vegas Sands stock, the Las Vegas Sands stock gaming revenue in 2019 accounts for 70% of the total revenue, but only contributes to 50% of the total operating income. This indicates to you that the non-gaming operating income for Las Vegas Sands is also about 50% of the total operating income. I believe that Genting Singapore could learn from Las Vegas Sands going forward, probably placing less emphasis on gaming revenue and more emphasis on non-gaming revenue. This is particularly important for Genting Singapore, as there is always a lot of uncertainties associated with gaming revenue, such as win rates beyond Genting Singapore's control. Other than that, Thailand is considering opening of casino resorts, which could impact the casino revenue of RWS. Additionally, Osaka, Japan is set to open a casino by 2030. I believe that Chinese tourists may prefer Japan and Thailand as travel destinations over Singapore. Japan is probably closer to them, so if Chinese tourists have the urge to gamble, they may simply fly to Japan, Osaka. So the competition is intense going forward. And one thing I don't like about gaming revenue is that there is a decline in gaming revenue before the pre-COVID era, from 2.1 billion in 2013 to 1.6 billion in 2019. So you just don't know if gaming revenue should be the focus of Genting Singapore going forward. Personally, I would prefer Genting Singapore to focus on increasing the non-gaming revenue. The non-gaming revenue is 758 million in 2023, which is 91% of 2019 level. And there is hope that the revenue contribution from non-gaming will increase in the coming years, because the company recently announced plans to invest more in the revamp and upgrade of the casino resorts and theme park, allocating a total of 6.8 billion as part of the Resort World 2.0 program, out from an initial 4.5 billion itself. So I'm happy as long as they are growing the non-gaming revenue. The revamp itself includes the construction of a new 700-room hotel, as well as a retail space of with a gross floor area of 21,000 square meters, according to preliminary approval released by URA. We also know that Minion Park and Super Nintendo World will be added to USS, along with other development that will be added to more than 164,000 square meters, about half of its current gross floor area. Marina Bay Sands has generally been more successful in attracting gamblers than Genting's Resort World Sentosa in the past, given its more advantageous city center location. So I believe the future for RWS is to boost its non-gaming revenue. Hopefully, when tourists patronize the attractions, they will also visit the casino. And you could see most of the development will come live in 2025 and beyond. So I see that if there is a dip in share price in 2024, probably it could provide a good opportunity to accumulate in anticipation that the expansion plans will bring in more non-gaming revenue. The valuations for Genting Singapore still looks inexpensive. In terms of forward PE ratio, the 10-year average is 21.6 times, and it is trading at 15 times now, which is near to the 2020 low itself. Let's look briefly at the technical analysis. So it went up as high as $1.05 1 week ago, and is now trading at around 91 cents. I think that since we could also see that after it broke below $1 in 2014, it was facing great difficulty maintaining above $1 in many, many years. And most of the time, we see that the share price trading under $1. So there may be a lot of selling interest above $1. My preferred investment strategy is to accumulate Genting Singapore at 0.78 Sing dollar, which is about 13% drop from the current share price of 91 cents. I reckon investors may accumulate Genting Singapore in the second half of this year in anticipation of some of the non-gaming attractions being completed in early 2025. However, if the number of Chinese tourists is good, it will attract some buying interest. So we just need to probably wait and see in the case of Genting Singapore itself. In conclusion, I believe the recovery in Chinese tourists should have support the share prices of some of the Singapore tourism stocks. Here, I also like to show you some performance metrics of the tourism stocks I just mentioned. So here are the yearly returns for SIA, Genting Singapore, Far East, Comfort, STI Index. Here show you the annualized returns, and here are the 10-year maximum drawdown and the volatility over the last 10 years. Okay, I would like to briefly talk about ComfortDelGro. I initially want to cover ComfortDelGro in this presentation, but given that Comfort just announced earnings after the market close, so I don't think that I will have time to look into it and include them in this presentation. But very briefly, I liked ComfortDelGro in the past. As you can see from the share price performance, it was one of the investment darling in the past. It had some of the best performing yearly return from 2004 to 2015 among the stocks here. However, we all know the second part of the story, in which the business model got disrupted by Grab. I think the total private hire cars might be the future, outshining the outlook for traditional taxi business. So even though ComfortDelGro is the market leader of the taxi business, it's not going to bring in good revenue growth going forward. So I think investor focus should be on the public transport segment for ComfortDelGro, which accounts for 68% of the total operating income. Investors should like ComfortDelGro because of its strong presence in the public transport business. But bear in mind that the operating profit margins, the operating margin was 7.8% in 2019, but the third quarter of 2023 is only 4.3%. So 7.8% in 2019, but now it's about 4.3%. I have not looked into the latest earnings yet, but I think the main investment thesis is the recovery of the operating profit margin in public transport. But if the operating profit margin in public transport remains compressed, maybe due to slow improvement in overseas venture, you need to think twice. However, it's also worth noting that the Public Transport Council announced a fare increase of 7.3% effective from December 23rd last year. So this should lead to an improvement in profit margins. And if you look at the performance in the last 4 years, SIA has some of the best yearly return among all the stocks here. Again, the main story for SIA is operating leverage. But if you look at the annualized return, you could see that SIA provided 0.3% and 1.6% in 5-year and 10-year annualized return, underperforming Far East Hospitality Trust and STI index in terms of the 5-year and 10-year annualized return. So I guess airline is a tough business in the long term, but short-term wise, the recovery in Chinese tourists may provide some upside catalyst for SIA. And I believe all of you may be wondering how STI index outperformed the tourism stocks in terms of the 10-year annualized return. It is because local bank stocks, which accounts for 47% of STI index weight, have been performing well for the past 10 years. And all of these local bank stocks have been some of the best performing stocks in Singapore itself. But again, I would say that if you are holding on to a pure Singapore portfolio, your pure Singapore portfolio cannot just consist of 100% bank stocks. Hence, you need some diversification. And tourism stocks may be a good alternative to banking stocks. I think for a pure Singapore stock portfolio, maybe a 10% to 15% weightage in tourism stocks is good enough. Okay, so I will go into Q&A session here. So if you have any questions, please type into the Q&A box. Okay, I see that there was no question. Okay, thank you everyone for coming. Sorry for the disruption at the beginning. Thank you all, and I shall see you soon. Bye.